right, we are going to get started. Welcome everybody to Transformational Tuesday. It is October the 14th. I appreciate everybody being here. I'm going to start sharing my presentation, and I got to make sure that I have participants because somehow they've created a waiting room for me that we didn't have. So that's all right. Just got to make sure I don't not let somebody in. So thumbs up, you can see my screen. Awesome. Thank you very much. All right. So I'm going to put my contact info into the chat. No, I'm not, because that's not it. Hold on. Well, I'll do it in a minute. I'm going to get going here. It's not picking up my thing. So today we're going to talk about how to build wealth without being a landlord. You know, a lot of people think that they have to be a landlord to be able to get involved into real estate. And I'm here to tell you that you don't have to be a landlord to get involved in real estate. So this is an educational series. So again, I'm not your financial planner. I'm not your accountant. I'm not your lawyer, but I do try to present what I believe to be true, fair, and accurate. And so make sure you do your own due diligence. So again, a little bit about myself. I started passive investing in 2017. I've been doing this now for 7 years. I am a passive investor in 20 syndications. I am an active investor in 14 syndications. We're going to talk a little bit about the difference of what passive and active is. And then I have 34 total deals. And so this is a little bit about Massive Capital. So I'm part of Massive Capital. My title is Vice President Investor Engagement. So Massive Capital is a vertically integrated real estate company. We're a developer of Class A retail town centers. We're an owner operator of value add multifamily. As you can see, we're very focused in the Texas market, but we do have assets in Denver, Colorado, North Carolina, and Georgia. We've also partnered up with Realty One. Realty One is the brokerage side of our company and the developer for the new build retail. For those of you that are interested, we're finally broke ground and we're going horizontal on our development Candela in Richmond, Texas. So they have about 300 million under assets, and Massive Capital has about 210 million under assets under management. We do LP and equity from retail and family office, triple net leasing and brokerage through Realty One, land development, steel frame construction, and then we do have Massive Masters, which is our mastermind, which helps teach folks how to be on the active side.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
So tonight we're going to talk about what is a syndication, GP and LP. We're going to talk a lot about forced appreciation. That's the real beauty of doing multifamily versus single family. Why multifamily still makes sense to invest. Obviously, I'm still challenging people to finish the year long, and we'll have an open discussion with Q&A. And again, sometimes these sessions are only as good as your questions. So again, a lot of times you know that I've said I spent a lot of my life going around the Monopoly board. As a child, I loved to play Monopoly, and I knew the people that bought the houses, converted them to motels, won the game. Then I became an adult and I fell into the same trap almost everyone else does. I went to work. I kept going around the Monopoly board. I collecting my pay. I was interested in being involved in commercial real estate. I was afraid of single family real estate, to be honest. I was terrified of toilets, tenants, and trash, but I always believed that I had to be a millionaire to be able to be involved in commercial real estate. Then I finally went to a seminar. I joined a real estate group, realized I didn't have to be, and I made it my mission to make sure that nobody is in the same boat as me. So a little bit about active income. Active income is pretty clear. You go to work and they pay you. When I was going to work, they paid me. Once they laid me off during COVID, guess what? They stopped paying me. You get interrupted, and then you no longer have any money coming in. So it's all dependent on time for money. You're trading your time for money. It requires your work and your energy. When you're a passive investor, you're putting your money to work for you. So your money goes to work and you'll make money even while you sleep. And you do this by investing in money making assets and businesses. And it does not require your time to make the money. Other people put their time in to make you money. So again, this is a beautiful chart talking about the different types of investments, right? And everybody was told we had to have savings, and you should have some savings. I'm not saying you don't. You could invest in bonds, but again, bonds don't have any leverage. They're not real assets. All of my money was in the stock market, and even in the stock market through my 401k at work, because that's where they invested it. And there is some cash flow, there is some leverage. But when you invest into real estate, you get cash flow, you get to use leverage. And if you haven't read Rich Dad Poor Dad, it all talks about the power of leverage. Read it again, even if you have. It's a great book. You're investing in real assets. Over here, you're investing in companies. Over on this side, you are investing in assets. And then obviously there are huge tax advantages in investing in commercial real estate. Love him or hate him, when Donald Trump was debating Hillary Clinton, he said he pays no taxes. And the reason he pays no taxes, he was a real estate investor. And then he's now put back the 100% bonus depreciation, which is a great advantage. Talk a little bit about that a little later in our presentation. So again, real estate syndication is a group of investors who pool money to buy or develop real estate. Syndications are a way for investors to invest in larger properties they couldn't afford on their own. How it works. Sponsors, general partners, and if you remember in my other slide, I was involved at 14 and I joined up with some experienced real estate professionals who organize the syndication, secure the funding, and implement the business plan. The passive investors, they're called limited partners, and they fund the project and they actually own a portion of the project. So again, I'm going to give you an oversimplified version of a story to give you an idea. We're going to buy a $10 million property. So we're going to probably be able to get about a $7 million loan. And on the $7 million loan, the general partners, they are responsible for getting the loan. They're the ones who qualify for the loan. So they'll have the net worth for the loan, they'll have the liquidity which is required for the loan, and they will have the experience. Because again, nobody's giving loans to people who don't have the experience. So you have to have all of those three things to be able to get a loan. So they'll go out and they'll get a $7 million loan. But we'll still need $3 million worth of money to buy this property. So we're going to go to our passive investors and we're going to say, hey, would you like to invest into our syndication? And then the passive investors invest. Now, this is where the real beauty of the story is, because this is like double leverage. So we're buying this $10 million property. And in theory, we're only using 3 million in cash because we have 7 million in bank debt on leverage. And here's the real beauty. The passive investors will actually own 70% of the asset. So think about that. The passive investors are putting up 30% of the capital, but they own 70% of the asset. And you actually own a portion, fractional portion of the asset. It depends how much money we've raised, how much you've invested as to what percentage that is. But it's quite amazing. It really shows the power of investing in syndications. So again, it protects you as a limited partner, protects your personal assets beyond the investment. Now, I'm going to be honest, your investment is at risk. There is a risk that you could lose your investment, but you are not responsible for anything else. So if they come back on the bank loan, if there's some sort of major claim, some sort of thing happening, it's going to not be the limited partner's responsibility. It also allows you to target an investment on specific projects. So I always tell people, especially when you start investing a lot like I do, you want to invest in different asset classes, different areas, different risk tolerance, even different timelines, right? Because you want to have a fairly balanced portfolio. So you don't want to be all multifamily in one city or all storage in one city. You want to have a little bit of diversity. And again, it can take some time. I got a lot of deals, so I managed over the time to be able to get some diversified. And then again, the returns are directly tied to the success of the project. So when we make a dollar, 70 cents of that dollar goes to the passive investor, and 30 cents of that dollar goes to the sponsors. That's how we make our money. Now, we often put in what's called a preferred payment, and a preferred payment puts the investors first. So until you've made 7% on your money, and that's an accumulative, so it may take a year or two, sometimes 3 years to get caught up on the full 7%. But when you do, then the split takes place. So it's a real investor friendly way to do it. So there are two types of syndications that we use, and we always start our deals as a 506B. In the past, before they did this Jobs Act and a lot of things and allowing it to where it was easier for the average person to invest, it was only accredited investors who can invest. So on a 506B investment, we must have a pre-existing relationship and you must be considered a sophisticated investor. So a pre-existing relationship means you've booked a call with me, we've been talking, we've had a few interactions, and you get an idea of who I am and who you are. A sophisticated investor, so we help you with those. That's why I do these webinars to help people become sophisticated investors. That's why I do one-on-one calls with people. There's a lot of things that we can do. And also, there are only 35 non-accredited spots on any deal. So if we're raising on a large deal, it can be where we fill up these 35 spots pretty quickly if we have a big capital raise and it's a really exciting project. So again, our goal is to give the massive capital community first access to these deals. And later on, I'll tell you, you need to tell me, hey, listen, Trevor, I want to make sure I get on the next deal. Let me know all the different things. So we can definitely be able to get some ideas to be able to do that. Now, and I can't do any general solicitation. So if I have a 506B deal, I can't talk about it tonight because this is a public webinar. I can't talk, I don't know if I have a previous existing relationship with you, and we upload these to YouTube. So that breaks the syndication rules. So I never talk about those deals here. I talk about them on some closed loop groups that I'm in or with established relationships. Then we will switch our deals to a 506C. And just an idea, we normally will hold them as this 506B for about 30 days. It really depends on our closing timeline. But we got to get all the paperwork, get everything ready. We do a webinar, a couple of weeks for people to finish their investment. And once it switches, if you're not accredited, you can't get in. But I also want to make sure I'm clear on a 506B, both accredited and non-accredited can invest. We just still have to have the relationship. So even if you're accredited, but I don't know you, you have to wait until we switch to a 506C. And again, a 506C, only accredited investors can invest. You must have a net worth of $1 million in assets, excluding your home, or personal income of 200 and a married income of 300. And for me, there's no restrictions on soliciting. I can market to everybody. I can talk about it on these calls. I can do everything. And note, there's a no difference on a 506B investment, only who can invest and can I market. So again, if you are interested in investing, you want to make sure that you let me know. And when I say let me know, that doesn't mean, oh, I said you're going to invest in the next deal. All it means is we need to make sure we establish that relationship. I mark you waiting for a deal, and then I give you first access to the deal. So please book a call with me. Make sure you get on the list. Now, this was a last project that we were able to talk, and actually I never talked about it on this call because it never even got out of 506B because we raised all the money. So this one here, we purchased an RV park for $3.6 million. We needed to raise $2 million, and we actually raised $2.5 million in 14 days because it was a really good deal. 25% IRR, 2.6x multiple, 11% cash on cash, cash flowing day one. It was a great asset. So again, we never even got to switch this. So if I didn't know you, you didn't even have a chance to be able to invest in this. So again, you want to make sure that you know that we have a deal coming. So again, my favorite slide this slide's going to be in every presentation I make to the day I die. If you don't find a way to make money in your sleep, You will work until you die. Okay, so here's my other favorite slide. I just want to talk about the power of compounding your money. So let's say you invested $100,000 into one of our deals and we doubled your money in 5 years. Now I've assumed no tax consequences. So again, that's a big assumption. And again, the fact that I'm saying we're going to double every 5 years, that's a big assumption too, but I want to make sure that you're getting the math. So you invest 100,000 turns to two. Then you invest the original 100 and the 100 you made, and it becomes four. Then you invest the original 100 and the 300 you made, it becomes eight. Then the eight becomes 1.6. The 1.6 becomes $3.2 million in 25 years. That is incredible. This is the power. I always say passively investing in commercial real estate is not a get rich quick, it's a get richer slow. If you leave your money burning, and a couple folks on this call, I know you're young enough to have 25 years left of investing in you, just think about this. This is only one investment and all of the profits reinvested so you can compound your money. Now, there are taxes. I understand there are taxes. Unless you were smarter than me, if you converted this $100,000 into a Roth IRA and you invested it, you would actually earn $3.1 million tax free. Where else but United States of America can you do something that crazy, right? Invest $100,000 and grow it to over $3 million tax free. It is insane. I wish so much I'd known about Roth IRAs earlier. I'm still going to make a move and move some of my money around. It's a lot to do with timing. So again, Charlie Munger, Warren's partner, first rule of compounding, never interrupt it unnecessarily. I've shown this chart just to show the power of compounding. You know, Warren Buffett's that man doesn't spend anything, right? He reinvests everything he makes. He's always investing his money. He's always reinvesting his money. He just keeps rolling his money over and over and again. And we all know he's been very successful. So again, a lot of people are afraid, right? Why don't you invest, right? You're afraid of failure, right? You worry that this new thing may not be successful or meet your expectations. You feel overwhelmed. You think, man, this is complicated. Trevor makes it sound easy, but it's really complicated and it can be a bit overwhelming. Perfectionism. I don't really know everything. I got to wait until I know everything. Well, I'm here to tell you I've been doing this 7 years. I still don't know everything. I'm learning something every day. I attend webinars just like this that other people are putting on so that I can keep learning. Self-doubt. I don't know if it's good for me and I don't know and I don't know if I want to do something new. Social anxiety, right? Everybody else is in job. They're going around the monopoly board, collecting the pay, maxing out their 401k, investing in the stock market. I don't want to be the only guy that's not or girl that's not doing that. And then you just don't feel like you're qualified to be able to do it, right? It can be really fearful. And Baron Rothschild said, you buy when there's blood in the streets, even if it's your own blood. And there's been some stress in the market. We talked about it on a few other calls. He looks pretty stressed himself if you actually look at his picture there. Very successful. And again, my good friend Warren, be fearful when others are greedy and be greedy when others are fearful. Warren Buffett just dumped $1 billion into real estate this year. So I think he's being greedy because everybody's being fearful. So we're going to talk tonight a little bit about the purpose of multifamily. The real secret sauce in multifamily is this thing called forced appreciation. Okay, it is the secret sauce of multifamily. And so it's simply when the rental property owner applies changes to his or her investment strategy in a property that increases the net operating of the income. Many time real estate investors intentionally look for value add real estate deals so they can quickly force appreciation. We are always looking for value add deals. That's why we're buying it, right? We want to increase the property. That's how we're doubling your money. So there are 7 ways to force multifamily appreciation. The simplest and most obvious is increasing the rent. Now, you can't go in and make no changes to the property and just say we're moving up the rent. Now, you may be able to do it a little bit, right? Because a lot of times you'll buy a property and the current owner's just not pushing the rent to a different level. There's a lot of things that happen. But again, you don't have to do anything to do it. And even a slight rental increase can be significant in property values. I've talked about this before. On our apartment complex in San Antonio, we have 200 doors and we're increasing rents about 8%, which works out to an average of $100 per door. Once all 200 apartments have been increased $100 a door, assuming we don't increase any operational costs and some other things, that goes directly to the net operating income. So we bought that property for $16.9 million. By putting the rent up $100 per unit, it actually increases the value of that apartment $4 million. So that apartment will eventually be worth over $20 million purely by pulling the one lever of rent increases. Then there are facilities, right, that you can add. You can add lots of facilities. So sometimes you would add facilities just to make them nicer to attract more tenants. Sometimes you might add some facilities as rental, like earning some money. You may be able to, like some of our properties, we've put on storage lockers, we've put on package accept lockers. There's things that you can do. You can put on all different types of packages to be able to do it. Some of our properties, we've added covered parking. I'm a passive investor in a property and they put in 26 parking spots and I just got an update, 22 of them are already leased. And that's adding to the value of the property, right? Because it's increasing the cost. Yes, there's the cost to build them, but at the end of the day, the real goal on multifamily apartments is to increase the net operating income. Obviously, there are a lot of services you can add. You can add laundry if there's not laundry, or you can, and it can be a pay for use. You can add vending machines. You can do valet trash. You can do lots of different things. We really do a lot of things like paid parking. So just think about it. You take a parking spot and you spray paint on it, reserved, and you say it's reserved for Mike and unit one. We probably don't want to say Mike and his unit number because people might knock on his door because he's so good looking. But you know, reserved for this tenant, right? And you can charge for that. And a lot of things that maybe have originally been complimentary, you're able to charge to be able to do it. Rent extra spaces. So, for example, on our apartment complex in the San Antonio market, the Horizon, we have a basically it's like a garden. It was a facility that they were trying to rent out for birthday parties and that, and it was never rented out. Our goal is once we reach a higher occupancy, we can turn that into 2 luxury apartments with pool front access and be able to charge for them. We have a storeroom that's above the apartments that could easily be converted into 2 apartments. And again, adding 4 apartments, increasing the rent by that amount is amazing. I also told before we have a property in Fort Worth, Texas, and we were really struggling to rent out the larger 2 bedroom, 2 bath apartments. They were about $1,350 rent, and we were really struggling in that area because the people just couldn't afford it. Plus, we just didn't have that many families staying there. So what we did was we carved out a studio in the back, and we made a 1 bedroom, 1 bath studio. It's about 600 square feet, and then we turned the front one in. It's still like 870 square foot, 1 bedroom, 1 bath apartment. And instead of getting 1350, we're getting 1050 for the front and we're getting 950 for the back. It's crazy. 950 for the back just because it's that much less. And they're beautiful new units. They're really nice units. We did a tour a couple months ago of that property. Obviously, you want to cut down on property expenses, right? You'll never save your way to prosperity, but you can definitely cut expenses. So we'll bring in property management, we'll use different things, we'll make sure that we're doing the best that we can to control the expenses. One of the biggest ways to control the expenses is preventative maintenance, right? So making sure that your tenants are changing their AC filters. I know that sounds really simplistic, but in hot Texas, if you've got a dirty air conditioner filter, you can do thousands of dollars worth of damage to the air conditioning unit. So just little simple things like that. We also, on those particular units, they're all bills paid. and our thermostats in every units are locked out. It can't get colder than 68 and warmer than 72. We lock them out. They can't make them too hot, they can't make them too cold, and we keep them in a comfortable range to where because again, what do? They leave the AC cranked down, freezing cold, go to work all day, 8 hours, nobody's there, or different things. So we actually lock them down so we can control the expenses. You can also put in a lot of water savings. Water, especially in the Texas market, super expensive. And if you can reduce the water bill by 30–40% by putting in low flow toilets, showers, sinks, lots of things, you can really save a lot of money. So there's extra fees, right? So you can do all kinds of things, right? So there's late fees, there's pet fees, there's fee for just about everything. When people go month to month, we charge a month to month fee. So there's a lot of ways that you can just increase. And again, I know it sounds like we're nickel and diming, but what we're trying to do is increase the rent. We're trying to be able to lower the expenses, and then we're looking for ways to add extra income to the property. And then how do you calculate the property's appreciation, right? So there's an investment analysis comes into play. Calculating the appreciation as part of the property's analysis, you'll need both the net operating income as well as the cap rate. So basically it's the net operating divided by the cap rate. So we've already explained what NOI is. What is the cap rate? It's kind of a confusing thing. It's the capitalization rate, is basically the amount the return of investors should expect relative to the property value. In other words, you divide the NOI by the total property value, and you have the rate of return on your multifamily investment. And again, these cap rates are normally set by brokers or different things, right? So it's amazing, right? So again, property appreciation equals NOI divided by the cap. So I've shown this slide before, but I'm going to keep showing it because I think it's a great slide. This one shows the fact that right now, many Americans are priced out of buying a house, and they're going to be forced to be lifelong renters. This red line is rent increases. So we start here in 1970, and you can see rent has been pretty consistent. It's starting to ramp up a little bit, right? Because there's been a lot of inflation. There's been a lot of things happening. This is the equivalent paid in a mortgage, right? So there is a period where it was actually cheaper to own a house than it was to rent an apartment. But check out this delta that's happened in here. And that's happened because housing prices went way up and interest rents way up. I keep looking for something that's got closer data like 23 and 24, and I've been unable to get it. I'm going to keep looking, but I know it's even gotten greater. So it's pretty crazy, right? So again, multifamily properties remain a good option. They're a reliable source of income from multiple tenants. Again, if you have a single family home, the tenant moves out, you're not collecting nothing till you refill it with a tenant. On our 200 unit, we're always running about 90, 92, 93%. We always have available, and we always have people paying the numbers, right? We have the economies of the scale. So even if one unit is vacant, the other ones keep the cash flow, reducing the risk. And then in strong markets where there's good rental, vacancies can be filled up pretty quickly, maintaining consistent cash flow. And then again, multifamily appreciates over time. So you got to remember, it's already appreciating over time. We're just forcing it to appreciate even quicker by adding the forced appreciation. A lot of people don't realize this, but multifamily and commercial real estate can often be easier to secure financing. Now, again, remember I mentioned before that the sponsors have to have the net worth and the liquidity. So what that means is on that $7 million loan, they have to have a net worth of 7, and they have to have a liquidity of $700,000, which means something that can be converted to cash quickly. And they have to have the experience. So if you don't have experience, but you're wealthy, they're not going to give it to you. If you have experience, but you don't have the net worth, they're not going to give it to you. It is a very complicated structure, but they're pretty easy to get. And one other thing that's really amazing, so let's say I bought a $10 million apartment, I got a $7 million loan, and everything went great. I can go buy another $10 million apartment, and I'll actually qualify for another $7 million loan. I can buy another $10 million apartment, and I'll actually qualify for another $7 million loan. Now, eventually, they'll start to notice and maybe make you a high risk. But it's quite interesting how that you can get several loans on your net worth and you're able to do it. And you can just grow quicker. We talked a lot about the tax advantages, right? So obviously we can deduct all of our expenses and everything from operating our property, and then you get the depreciation. So we do the cost segregation. So when you invest passively in a real estate syndication, we always order a cost segregation. And instead of writing things off over 27.5 or 39 years, we break it into faster depreciation parts like appliances, floors, even landscaping, and then stack on bonus depreciation, which is now at 100%, making a massive paper loss. So I'm going to talk a little bit about that paper loss, and it can be a little bit daunting. And again, I'm not your accountant or financial advisor, but roughly if you put in $100,000 on a multifamily deal, you're going to get anywhere from $40,000 to $60,000 year one passive loss. It's called a paper loss. You didn't really lose the money. And if you're a full-time real estate person, you can put that against your total wealth and your total income. If you have a W-2, you can put it against your passive income from real estate investments. So once you start making money, you can use those losses. Now, the beautiful thing about these losses, it's not a use it or lose it. So if you can't use it all this year, you can save it up and use it next year, save it up and use it next year until you're able to use it all up. You can keep rolling it forward. So again, in multifamily, you had diversification and stability, right? It adds a lot of stability because we got multiple units. People always need a place to stay, making multifamily properties fairly resistant, recession resistance compared to other commercial types of real estate. The occupancy rates hold steady and lower rents per unit compared to single family homes or owning a home make it a very affordable option for people. So again, we talked a lot about it and I'm not going to go too much into this, but the scale, right? The scale of operating a business. So again, I want to make sure I'm clear. When we buy a multifamily apartment, we're buying a business that operates within an asset. We're hiring professional property management company that does this for a living. So this is what they do for a living. They run apartment complexes. So they'll come to the property and they'll bring their team. So depending on the size of the property, we'll have a regional manager. We'll have a property manager. We'll have a leasing manager. We'll have a maintenance manager. We'll have somebody who takes care of the apartment make readies. And we do all of the work in-house pretty much. So our lead maintenance person will have their HVAC ticket. They'll have their pool, whatever they need for doing the pool certification. They'll have a lot of certifications, which will save us from having to hire outside more expensive vendors so we can buy our own materials and do them. Now, we do hire outside third-party vendors for complicated things, electrical major things, but we do a lot. And so we can save a lot of money doing these in-house. So our teams will do all of the make readies. They'll do all of the unit turns. They'll do all of the maintenance tickets. It's super powerful to be able to do it that way. Now, if you want to learn more about multifamily and you are in the Texas area, I have a tour and it's on October the 30th. I'm going to put it, oh, well, I'm having a hard time copying and pasting today. I don't know why my computer doesn't like me today. So we're doing a tour. This is a property. This is a deal that's already closed. This was 60 units in Sealy, Texas, which is on I-10 as you're driving from San Antonio to Houston. It's going to be from 2 to 3:30. So it's 15 fourplexes, and you can see they're very nice fourplexes. This is a B-class property. And again, this was a property that we'd been looking at for more than a year trying to buy. And finally, the conditions were right to buy it. And we're going to be meeting there. So this will be about our 6-month anniversary. Actually, I think it's pretty close to the day of our 6-month anniversary of closing the property. Our lead sponsor, who's part of the Massive Master program, will be there. I'll be there. And we invite all existing investors, people from my Tuesdays, people from our real estate groups and clubs. And what we do is we walk the property, answer your questions, talk about how do we create the forced appreciation. So on this particular one, we bought it and they had an office and a show unit. really crazy. An office and a show unit. It just made no sense that they're going to take 2 units offline when they only have 60 units. So when we talk about forcing appreciation, adding 2 units massively goes to the NOI, right? It really just adds huge value where you're going to put be able to add those two to your income. And we've hired a local property manager, and they actually have staff at a property down the street. And it's in two very different rental models, right? This is on a quiet line street. These are people that want a little bit more. This is closer to living in a house because it's a fourplex. We have 2 parking spots right in front. All of these units are 2 bedroom, 2 bath, exactly the same, which also again makes our renovations and our upkeep very good. So if you can, if you're in the Texas market, please come and join me. We really do enjoy it. And of course, I'm not going to end by saying don't wait to buy real estate. Buy real estate and wait. Real estate is a time game, right? This is where you're going to buy it. And remember that other slide. You're going to wait, and that money is going to keep growing. And if you keep reinvesting it, if you keep doing different things, you're going to be able to grow that $100,000 into at least a few $1 million, even with taxes. It's pretty amazing. So again, you still have time this year. You want to make sure if you're looking to get some bonus depreciation, you want to get an investment done this year, or you just want to, if you've never invested, you want to make sure that you do it, right? You want to finish your year strong. So for the ladies on the call that want to go join Jasmine, she's doing her call the first and the third Tuesday, so next week. I'm going to put it in the chat as well. Jasmine, and Jasmine was my cohort for the last 3 years, and we've moved her over now. We've restructured it, and she's actually doing land acquisitions right now, trying to get some land deals. So it's pretty exciting for her. And of course, we all know I'm here now only the second Tuesday of every month. So spread the word. If I can get more people, like if I could have 30, 40, 50 people, I'd go back to twice a week, but I need to be coveting my time. And I appreciate the folks that show up all the time. I just need more people to justify getting ready to do everything. So again, even though I've talked about being passively, you have to be actively passive. And what does that mean? It means you need to be educated, right? It means that you need to learn. It means that you need to come to these calls. You need to connect with people. Wherever you live, you need to be talking with people that are doing real estate groups, doing different things. If you are interested to switch over to the active side, you can definitely connect with me. We do these Centurion Expos. They're 3 days, very similar to what I did 7 years ago. I went to one of these 3 days and I joined a mastermind. And it's going to get you, if you want to become active, if you want to switch and say, okay, I want to not be passive, I want to be active, please reach out to me. I can get you a discount on the things. Phil does a commercial call tonight at 7:15. If you want that link, let me know, or you can quickly scan this. And again, massive dreams need massive action. These are the three main partners of Massive Capital. They never took any fun pictures. And so I made them take this picture and said, you got to get a little more zing in yourself, right? And you're one decision away from a new life. Decide to take massive action. So I've said this before, my goal is to help 100,000 people reach financial independence through real estate investing. And I hope one of you will join me on this journey. And how this started, again, I was always interested, but I didn't understand. I thought I had to be a millionaire to invest in commercial real estate. And when I found out, I said, this is it. I'm going to create a goal because they tell you to set these goals. So I said, I'm going to help 1,000 people. And then, of course, I read Mr. Grant Cardone's 10X and said, well, I need to put that to 10,000. And then once I started coaching on another real estate group, and we've got about 5,000 members in that group, and all the folks through Massive Capital, they said, well, they're going to increase my goal to 100,000 people. So I hope that you'll be one of the folks that will invest with me. Anybody have any questions? It's good to see you. Oh, we got a few folks that joined while we were going. Good to see you, Hillary. Glad you could make it.
May I ask a question about the Vale
Yes, sir.
apartments? So you said they had 2 units that were not being used. One was a show and one was an office.
Correct.
And so I'm kind of trying to wrap my brain around what good management would do. I'm thinking that I've been in apartments where they just show you units that are ready to be rented.
That's exactly what we're doing. That's
Wonderful.
exactly what we're doing. So we're getting a unit ready. We're also doing virtual tours where we're actually touring through the units with the tenants. And we have pictures of staged units so that we can say this is what your unit would look like. And of course, these ones are pretty simple because all the units are similar. But yes, once you have a unit that's vacant and ready, you can show it and be able to get it. But you want to have something to at least get them somewhat interested, uh, because you don't want a long gap between when it gets unrented to rent. And then not having the property manager on site. Today's technology, all of that goes through apps. You put your maintenance ticket into an app. No, no, you don't need to go knock on the door and say, "Hey, my sink's clogged, or my toilet doesn't work, or my AC." You just go on your app, right? And a lot of the property management companies have these AIs where they'll actually ask intuitive questions and then create a trouble ticket, and the maintenance person can come the next day or depending on the severity. And then we share maintenance with other properties and we just get billed when they're there. We also share, we have some overhead cost for the property management company. And then when they come to the property to do a tour or to move somebody in, then we would pay for that.
Okay. Would the one last question, would the property management would on a one the size of Vale, would they be boots on the ground like during the day? Would they be there at any time or would they just show up like once a week?
So they
Or
have an apartment literally like 3 minute car ride away. And their
oh,
manager is there. So it's a shared manager. So she can come over, and same with the maintenance. They're there as well. It's a larger property than ours, and it's a different rental mix too. So yeah, so they can get there within, again, they may have appointments or whatever, but it's just set of somebody sitting there waiting to take action. We take action once there's something to done, and that's a huge cost savings, right?
yeah, I think that's a good way to boost up your return on investment. That's really good. Thank you.
Yeah. And with today's technology, you can put those coded locks on the doors and people can do their self tours.
So,
Hey, Jerome, did
quick
you have
question. This is Jerome here. I have a
a
one-on-one. Yeah, I have a one-on-one session booked tomorrow. Is that with you? I just wanted to make sure.
it's a good question. I'm not sure. It could be. I mean,
It is, I believe, at
most one-on-ones are with me.
clock.
Yeah, I see you. Yep, you're at
Perfect. So I
one.
think it's tomorrow, 12
Yeah,
o'clock
you're at
Central.
1 o'clock. Yes, sir. I see you. Yep.
Perfect. All right. Thank you, sir. Appreciate that.
Awesome. Thank you. Yeah, and if anyone else wants an appointment, just use that link. It's good to see you, Bob. You might have been missing my calls lately. I know you're a busy man.
Could I
Awesome.
ask a question real quick about the depreciation?
Absolutely.
So my wife does my taxes, so she knows more about it than I do. So she would be able to answer this question for me, but I don't understand. When you say you're taking the depreciation, does that mean that money that you're making at your W-2 job, you can count against that?
No, it does
So
not count against anything to do with your W-2 job.
how
So,
does that work?
so it would be against your passive real estate earnings. So if you've earned
Oh,
real estate from any investments through real estate, it would
yes.
offset those earnings. It doesn't offset W-2 earnings.
Okay, great. Because right, I'm invested myself and I haven't come to that point yet, but so I can use that as a tax deduction against what I'm getting
Correct.
in a
And
distribution.
right. So if you have a $40,000 loss, in theory, you can earn $40,000 tax free on
That's wonderful.
passive investments. Now, again, I'm not your accountant, your wife is, but there is some recapture at sale, just like everything, right? You eventually can escape death and taxes. So there is some recapture of that when it sells, but it's very negligible. And again, the most important thing, right, is when you're saving money, go reinvest it, right? So it grows. So again, I tell people, let's say you could use the whole $40,000 deduction. And instead of paying $40,000 in tax, you invested $40,000 in tax and you grew that. Then that's incredible. Yeah.
Okay. I think I understand. Awesome.
Yeah.
Thank you again.
Yeah, it's very powerful. Awesome. Anybody else got any questions?
Yeah, no question. I just I'd like to know if you're allowed to picking deal on your group or no. Like picking deals, like I have some deals right now and then I want to share.
So we're
Did you?
only doing deals within our Massive Masters group.
Okay. All right. That's okay.
Yeah.
Thank
You
you.
just need to come and join us. I know you'll love it. It'll
What is
accelerate.
that?
I
The
know
deal
you'll
on
love
what?
if you join the Massive Masters, it will accelerate you like you've never believed. That's the goal of the program. That's how we do it, right? So the last 5 deals I've done have all been helping Massive Masters get their deals closed. So the one we're going to see in Vail, that's one of our Massive Masters. We held his hand all through it, but he is the primary
So how it
general
works?
partner.
Is it a fee involved and everything?
That's correct. It's a mastermind, yeah.
But it's can you tell me a little bit about that? How much it costs and everything?
Yeah, we can do that on a private call if you want to set up a link. That'll be fine, yeah.
Mastermind.
Yes.
Okay. All right. Perfect.
Awesome.
Yeah.
All right. Well, I really appreciate everybody showing up. For those of you that don't know, yesterday was Canadian Thanksgiving. I'm in Canada. I had a wonderful time with my family. And I'm here for another couple of weeks seeing them. So I will see everybody next month, unless you're going to come to my property tour. Awesome. Thanks, everybody. Have a good night.